Welcome, Tom Durezzo, everyone. And Tom, director of the product management group. You're the one that brings the new attractions, the new vendors, the new upgrades to the system.
I'm part of a team that does all that on
Yep.
behalf of our subscribers.
And
Yes, sir.
and according to Michelle, a lover of statistics, an aficionado of statistics, and certainly that's why
Yes.
you and I've been doing the Statistically Speaking show for a while now with Michelle in the background. She's collecting the questions that you folks can put down there in the Q&A area. On the bottom of your screen, and feel free if you've got questions as we go through the hour here. Let us know. We'd happy to pitch them up to Danielle for her comments. And with that, I will introduce Danielle Hale. Danielle, if you go ahead and there she is right there. Hi, good afternoon. Um,
Hello.
hi. I want to do a little bio for everyone about you. I looked you up, and
Okay.
absolutely. I grabbed it from one of your own websites. So you are the chief economist of Realtor.com.
Right.
And you are absolutely recognized by the media, whether it's the Times, the Wall Street Journal, Forbes. You are their go-to person when it comes to the statistical performance of residential real estate in the United States. Is your forte, as they say. But before that, for 9 years at NAR, which I didn't know that at the National Association of Realtors, as one of their economists and policymakers or policy researchers there. And then it got even more interesting when I looked the next layer back. And back in 2008, you were with the American Enterprise Institute and
That's right.
assisting with, as a researcher and a contributor to Dr. Alan Meltzer's A History of the Federal Reserve, Volume 2, put out by Chicago University of Chicago Press. And I found that sort of interesting because of my brain went, it could be time for Volume 3. We
Yeah, actually, that's a very good point with all the Fed news that we're
may
getting
want to look
lately.
into that because certainly a
Hmm.
lot's taken place. And but we welcome you to Statistically Speaking with MLS Listings and its members. And Tom, you've got a lot of questions to get started with, so let's dive right in.
I think everybody's looking forward or counting on interest rate cut coming up for the Fed rate. But of course, when we talk about interest rates, we're talking about mortgage rates, um, which is, I guess, a little bit different. But you recently noted in a video that you had a couple of weeks ago, that it's all baked in already. Can you talk about that a little bit?
Sure. Yeah, absolutely. And you made the very same point that I was going to make if you didn't make it, which is that, Fed rates and mortgage rates are really different. And from the residential real estate perspective, what we care about is the mortgage rates. And a lot of people get that confused within the industry, but certainly consumers who are not used to tracking these things on a regular basis. So I think that's really important to distinguish. The Fed sets its short-term rate, which is an overnight lending rate between banks. And it's sort of this risk-free interest rate that sets the floor for interest rates across the yield curve. And then, investors are making decisions about what they're going to do with their money. You can, put it in a bank and you tend to get a rate that's very close to whatever that overnight interest rate is, which is, it's okay, but not great return, generally speaking. Or you can invest in other types of securities, bonds, longer dated instruments will generally, though not always, generally give you a higher rate. Right now, we don't see that quite as much because the Fed funds rate is so high. But for the purposes of tracking mortgage rates, the 10-year Treasury yield, so that's the rate that the government pays to borrow for a 10-year bond is a good proxy. And that's because mortgages are longer dated instruments. The typical mortgage is a 30-year mortgage, but most homeowners actually don't hold on to their mortgage for a full 30 years. So mortgage rates tend to track against the 10-year Treasury very nicely. The US government rate is thought of as a risk-free rate. And then because mortgages are a little bit riskier, they tend to have rates that are slightly above that 10-year yield. So when I say that the Fed's rate cut is baked in, when investors are making decisions about long-term interest rates and investing in long-term bonds, they're thinking not just about what interest rate policy is today, but what it's likely to be over the next 10 years, which is when they're usually going to hold on to that long-term bond. And so they're thinking not just about what's happened, but what's likely to be ahead. And there's actually been a lot of consensus around the Fed cutting rates in September. I know it kind of doesn't feel like that because there was some division over whether they were going to cut earlier in the year, and they haven't yet. And so as we get later throughout the year, more and more economists are aligning around the idea that September is probably going to be the date. In fact, there is a group that does futures contracts. So you can sort of invest based on the odds that the Fed is actually going to cut rates. And those futures markets suggest that investors put like a 95% odds on the Fed making a rate cut in September. So there's already a pretty broad consensus among investors that we are going to see a rate cut at that Fed meeting. And we've seen longer term interest rates and mortgage rates come down in advance of that. And folks who've been in the business for a little while will remember a year ago when the Fed made its first rate cut, mortgage rates actually declined up until the date of the Fed meeting. And then they actually went in the opposite direction. So that's just a very fresh reminder that mortgage rates and the Fed funds rate don't always move in the same direction. The Fed cut rates by about a percentage point, and from September to, I can't remember if it was February or May of the following year, mortgage rates went up by almost a similar amount. So they don't move in lockstep. It's really about what's anticipated ahead for the economy.
Follow-up to that is I was talking to my mortgage guy today, as one does, and he was telling me that there's a jobs report that comes out tomorrow, and I was interested in this because he's like, I'm hoping it's really bad, and he's like, yeah, a bad jobs report would maybe force the Fed to even look at maybe a slightly higher rate cut. This is a mortgage guy talking. What does the Economist say?
Yeah, I would say we're sort of in this topsy-turvy section of the business cycle where it's almost like you want to root for bad data, which no one really does, right? In the long run, it's good for the economy to do well, for people to have jobs because people with jobs are the ones who buy and rent houses. But in the very short term, if the jobs report is worse than expected, then that does potentially raise the odds of the Fed making a bigger cut. I don't think that that's the most likely outcome. I think we're going to see the jobs report come in somewhere between maybe a small job loss to a modest job gain. I'd say anywhere between, you could say, negative 50,000 to plus 150,000. I know that sounds like a big range, but the margin of error on those jobs reports is actually pretty big. And so you've probably seen in the news about, the recent revisions that we had in the jobs report. That's one of the reasons. And if you look at, an economy of 150 million workers, the revision of 100,000 workers in any given report is actually not that big. But that said, so I expect it's going to be, modestly above zero, could potentially be below zero. And I think that means we're likely to see the Fed make a 25 basis point cut in September.
Tom, I do want to, and Danielle, I do want to go into, the media versus about the national versus the reality of what's local for us here in a predominantly Silicon Valley region of the United States. So we hear nationally, we read it, of the demand coming down, the buyers, not as engaged as they once were. We know that inventory rates are up, and just the normal laws of supply and demand. Some prices nationally are dropping. Yet here in California, here in Silicon Valley, we're seeing an increase, Tom, in the inventory level, but it's not reflecting in the price. The prices are staying strong, and we're wondering about your sort of insights and observations of why that would be true here in Silicon Valley, that it sort of goes against supply and demand.
Yeah, I think it does. It is really important to consider that local context, especially when The national trends that we're seeing are largely kind of stagnant.
Okay.
And what that's doing is hiding a lot of variability at the regional level. So, generally speaking, in the South and in the West, we've seen greater inventory growth and more of a price softening or slowdown. But as you noted, less so in the Bay Area. I think we didn't see, you did see prices run up, but not quite as much as in some southern markets over the last couple of years. And so I think that's part of it. There's sort of less of an opportunity to adjust. And then also, I'm sure I don't need to tell you this, that your market is very much dependent on the tech industry. And so while the industry sort of went through this period before the advent of AI, where maybe it had ballooned too much during the pandemic and some tech firms were cutting jobs, I think it's fair to say that that has largely stopped and that people are now investing in and looking forward to the potential of AI. And so I think that's led to this industry turnaround that's probably a little bit distinct for your market. And then on top of that, even even when the market was a little bit softer, you tend to have better unemployment rates than much of the country. You have a highly educated workforce. You tend to attract a lot of international demand. So our data shows that based on Realtor.com traffic anyway, which is, a snapshot or a subset of the market, but a pretty decent one. The traffic from abroad is like 3% in your market. And it's closer to like 2% nationwide. For comparison, in another large metro like New York, it's closer to 2%. So there is some outsized international influence there. And I think the other thing that's unique about your market with the tech industry being there and it being you have some established tech firms, obviously, but a lot of tech firms still operate in a somewhat, I guess, riskier environment. And so their compensation structures are often very stock and equity heavy. And so you have that element that is probably a little bit unique and keeps the market in a different place. So a
Right.
lot of unique factors going on there.
And many a mortgage is taken with stocks and equities and company ownership and that kind of stuff. So Wall Street can sometimes chew on us a little heavier maybe than other regions, Midwestern cities, that kind of stuff. Ourselves in Seattle, with those two high-tech roles, in the nation can be affected, in that manner as well. But we seem to rebound. We seem to find a way to, if we can't build houses, we certainly know how to, find them and buy them. We're good at that part. We just have no room for building new ones is not our forte.
Do you feel, Danielle, like buyers are like finally coming to grips with higher interest rates? Like because earlier it was like, oh, that's what's holding people back. But what's sort of your feeling?
I think yes and no. If you look at first-time home buyers, I think they are a little bit more open-minded when it comes to interest rates because I don't know about you, but even as an economist, I didn't really start paying attention to mortgage rates very much until I got into this industry. And then I paid a lot more attention when I was actually looking for a house. And I think that's probably not all that atypical, is that most people don't really think much about mortgage rates until they're trying to buy their first house. And so the good news for a lot of those first-time home buyers is that they probably were still in college or maybe, not really thinking about it when mortgage rates were down at 2% or 3%. So they, I think, are a little more open-minded about today's rates. So I think they're more willing and more eager, although you still have that affordability hurdle. So because mortgage rates have gone up since 2019, buying power at the national level has been cut by almost $30,000. It's $27,000. And that accounts for the fact that incomes have gone up. So people do have more income as a result of economic growth. But the drop or the increase in mortgage rates has meant that the typical house the house that the typical household can afford has gone down by $27,000. And we did this study looking at the 50 largest markets, and in the Bay Area, the numbers were just a little bit higher than the typical nationwide perspective. So you've had, some stronger income growth, but also very expensive real estate means that those mortgage rates really have a higher impact there. So in general, I think it's still even if people are more mentally comfortable with it, there's still the budget reality that, they just can't afford as much home as they used to on the same income. That said, there are some areas where we're seeing more income growth. And so buying power is less impacted in those markets. The other thing I think kind of holding people back is that if you did buy a home before interest rates reset, and if you um, either bought a home in that period or you refinanced a home in that period, you're locked into a very low rate. And so I know a lot of people who, might consider moving were it not for the fact that it would mean giving up that mortgage. And I think, for those folks, it's going to take longer to acclimate because it's not just a theoretical anchor. It's a real tie that impacts their bottom line and their housing costs every single month. But, I think as time goes by and people pay down their mortgages, and also as life events happen and they get more and more, they get to a point where their house is less and less of a good fit for them. I think that creates this demand pressure. And so I think, as time goes on, we'll see more and more people acclimate and adjust. Another thing that is probably worth noting that I observe is that when mortgage rates are trending lower, you do see a little bit of a pickup in home sales, but not as much as you would expect. But every time mortgage rates turn and start to go higher, that's when you see a really big jump.
The rush.
Oh, interesting.
Right.
Yeah.
So it is an interesting thing is that like when people expect mortgage rates to go down, they sort of think, well, I can take my time, especially in an environment where home price growth is not what it was. So they don't feel like they're missing out as much. But as soon as mortgage rates turn, people are like, oh, I got to jump before I miss it.
I know that home buying in itself stimulates the overall economy of a region because those home buyers go and buy washers and dryers and they have a new roof put on, right? And so it works its way down into an economy. What, are we seeing areas where, that drop in home purchasing is having a alternative or an additional effect on local economies?
That's a really good question. I would say surprisingly not so much yet, which is interesting. Consumer spending has held up relatively well, considering it, has had some big obstacles to get over. And yes, home sales do generally drive a lot of remodeling, moving costs, refurnishing costs. So it is interesting that we haven't seen more softness. I mean, the recent GDP numbers were a little bit softer, but that's more of, I think, related to shifts in trade policy than it is, home sales activity. But, we could get to a point where we start to see that more and more. The consumer has been incredibly resilient over the past couple of years. And so I think maybe, it's likely we would have seen even greater consumer spending growth had we seen more mobility that we just haven't seen over the last couple of years.
Right. Possibly sort of hidden in that cloud of what you say, the trade revision, policies that are currently in place, could be hidden behind all that, right? What's the trade policy versus what's the GDP, I guess.
Yeah, I think it is, in an environment like we're in now where the policies are changing so rapidly, it is really hard to pick out what is the single contributor to this outcome. We do know that, we saw the surge in imports. We expect to see a decline in imports as people sort of tried to front load and get ahead of those upcoming tariffs. But but when policy is unsettled, it's hard for businesses to make decisions because we don't know what the rules are going to be.
Right.
And so we did see some people act and try to front load, but what that means in the long run, I think it's going to take us several months to figure out, just because the policy environment has been so variable.
I briefly touched on new home builds, which we don't have here, but new home builds were affected by trade policy, right? Where do I get my raw materials from if they're going to be taxed or have a tariff put on of an extra 25%? Are you seeing changes in the new home build area as well that could possibly be pointed towards the trade changes?
Yes, the builders have pulled back, and we have seen housing starts slow and permitting activity as well. It's hard to say how much of that is trade related
Okay.
versus, builders have seen a little bit, they've reported at least lower buyer traffic in recent months. And so that could
Hmm.
also be a contributor. Um, but, again, it depends on where you are. So I did pull the data because for people in a lot of markets, it is the case that like new construction is a really good alternative if you're not finding what you like in the existing home market. And builders have been flexible with pricing and often throwing other incentives at potential buyers. So being willing to buy down mortgage rates or come up with innovative products. I just this past weekend saw a builder advertising a 7-year fixed rate of 3.99%. And then it was, variable. It would reset every 6 months after that, which, is a really good deal. We've got research that shows, buyers of new construction save in the last year saved roughly or had a half point lower mortgage rate than buyers of existing homes. So not everybody is getting those buy downs or not to that degree. But for buyers who are looking for ways to make today's housing market affordable, new construction can be, I think, surprising to most folks that it can offer some good opportunity. But I had looked, and you're right. You do have below average new construction. It's not zero, but it's certainly not as good of a strategy in the Bay Area as it is in
Right.
many other markets.
Definitely not as robust.
Shifting gears a little bit because we are talking about the Bay Area. And I think in the past you've talked about the importance of local data and having that. If you were a realtor and you're working with clients, what stats would you be sure to cover with your clients, right? So, our listeners are all transacting realtors. So, what should they be focusing on with their clients?
Yeah, I think I'd focus on the stats that help, excuse me, that help consumers understand like the state of the market. Because I think as agents, you're in it day to day and you sort of understand if it's a really hot seller's market or a really cool buyer's market. But most individuals, they'll read the national headlines, but they're not necessarily as familiar with the day to day in your local market or at the specific price points that are relevant to their home search, whether they're buying or whether they're selling. Um, the good news is you can look at the same statistics and just sort of reframe that information so that it's relevant for buyers or for sellers. But I like to look at stuff like time on market. We do a market hotness report that is based on time on market and also page views per listing. This is our way of approximating the demand in a market by looking at how many people are checking out properties on realtor.com. So when time on market is low, when page views per property are high, that signals a market that's really hot. So sellers are in a good position. Buyers need to come with a really strong offer, make sure they've got their pre-approval, they're ready to move. They can make a larger down payment and make that work. That might be a good option to help themselves stand out and be more competitive. And I think setting realistic expectations going into that is really important. Another thing to look at is the sale price to list price ratio. In today's market, they're probably pretty close to the same, but we've been through periods where, the list price is just the starting point, and that if you want to actually win a listing, you've got to go much, much over that asking price. Today's environment much better for buyers. That other environment is probably much better for sellers. But I think the key thing to, keeping everyone on the same page and sort of not coming away with too many disappointments, I think, is to set expectations so that, they know that what that listing price means basically when they get into the market.
I will ask the burning question that certainly Michelle deals with all the time out there. Median or average?
That's a good question. So we almost always report on the median
Okay.
because it is like the middle 50%, and half of homes are going to be priced above the median, half of homes are going to be priced below the median. usually, and I didn't look in your area, but I would imagine this is true. Usually, if you look at the average, it's going to skew a little bit higher because, there's sort of this floor. It costs money for the land and the construction and everything else. There's usually this floor that you don't see home prices go below, but especially in your market, you've got a really long tail on the high end, and so that tends to bring up the average. Each we always quote the median. Each is instructive in its own way. It just kind of depends on the buyer, but I would usually quote the median.
Gotcha. The long tail. I don't think I've heard it described like that before. I may use that one out there in the field. Tom, you had a question, I think.
Well, I just wanted to go back to the stat that Danielle was talking about, which
Right?
was listing views per listing, right? And because I think the question came in, how do we get that? And so I think agents can go to realtor.com and see listing views on a listing directly. But then we also have a tool called List Track. And List Track actually compiles views from a number of different portals. And so that is available to agents to grab that stat of how many views a particular listing is getting. And so if you don't have the List Track card, you can add it in the Pro dashboard, or you can go directly to listtrack.com and sign in and get the views.
So, Tom, you want to talk about insurance? Because if I go there,
I was going to say you should be the one talking about insurance.
I'm still scarred by my whole last insurance experience of having to say goodbye to my major carrier, whose name rhymes with eight, but it's a different one. And but I'm in a single family home up in the mountains outside of Santa Cruz, California. I've got redwood trees that are right outside that window. You sort of have to have an expectation of things are changing in the insurance world. And in fact, we're seeing a lot of people, better go get pre-approved for your insurance as well. Right, not just for your mortgage, but you have to be pre-approved almost these days for insurance. But I want to bring it back to the urban setting and more specifically common interest property. And Tom, you currently live in a common interest. When you were in San Mateo, you were in a common interest property. It's been some years before, since I've dealt with an HOA and that kind of stuff. But hard to get now, right? Who'd have thought it came out of the mountain and came down into the city? What are you seeing out there, Danielle, as far as how is insurance affecting? I'd love to talk local if you've got that information, but in general, what do you see in the future? Is this going to get better, or are we just going to have to change our buying habits?
I mean, I think buyers are going to have to definitely be aware. The good news is I think we've done some survey data that show that consumers are more interested and are thinking about this. Of course, it's one of several considerations, and it doesn't tend to top affordability in the near term of being able to make those monthly payments. But they are thinking about it because they do know that it affects the carrying costs of a home and affordability over the long run. On that question about common interest properties, we've not done a lot of research on that specifically, but I would say, advise your agents to pay attention to those HOA or condo docs as they get them. Look at the financials of the associations that are represented in those documents, and make sure you're doing as much due diligence as you can on the upfront. Now, of course, if the situation changes and insurance carriers change their policies, there can still be things that are out of your control, but making sure you're with an association that has good reserves can help offset some of that. As far as, the general risk, I think it's important that consumers are asking for this information and are interested in this information. So it's important that we provide it. So Realtor.com has partnered with First Street to make this information available on the property listing itself, so that consumers, and it's on not just active properties, but also off-market properties as well. So consumers, whether they're buying or whether they're living in a home, can get this information and think about ways to mitigate. if you mentioned redwoods, you're probably not going to chop down redwoods, but if you wanted to, but there are things that you can do to like clear
Right.
away the
You bet.
brush from around your house and make smart landscaping decisions to better protect your property. Um, my in-laws live in Jacksonville, Florida, on a river. I hear from my father-in-law regularly. He's not the biggest fan of this aspect of information on our site, but the point I make to him is, look, you've done some things to mitigate. You've invested in your seawall. You've made sure that your property is elevated. The fact that consumers have this information and can understand the risks mean that those mitigations that you've done become selling points for you. And if
Gotcha.
people weren't even thinking about it, they might not appreciate the things that you've done to sort of flood proof or better protect your home against flooding. So, unfortunately, this is just the direction that we seem to be moving in. We've got more homes in harm's way, and
Hmm.
we've seen greater intensity of environmental events, and those have costly ramifications. So the best thing that we can do, I think, is make this information available so that we can make smart decisions about making the investments to mitigate the risk. And that should lead to better insurance outcomes in the long run, even though it's going to be a slow process.
Right. And is that both on Realtor.com and Realtor.com Pro, that data?
Um, that's a good question. I am admittedly a little bit less familiar with the pro side. I believe
Okay.
that it is because I
Okay.
know for a fact it's available on the consumer
Yeah,
side.
they mirror
Um,
each other pretty darn closely.
Yeah, it's on the consumer side, it's in the environmental risk section.
Okay.
And we've got 5 different types of risks that First Street produces data for. It's flood risk, uh, fire risk, um, wind risk from hurricanes,
Okay.
heat, and air quality.
Gotcha. Um, your comment about, we're in a new era of danger, properties in the danger zone. I was traveling on the coast of California over the holiday weekend, and the fire burn patch comes all the way down to the beach, right? It stopped at the water line, where the CZ fire was back in 2020, and it was just sort of a reminder of, what's safe. It's if you can have a forest fire on the beach, you need to pay attention to your insurance, because anything can happen. Mm.
Yeah, and I mean, I think this goes to your point too about like insurers trying to better account for these changing risks and thinking about risk in the urban setting because we obviously had the Los Angeles fires earlier
Right.
this year, and I think um, I think that surprised a lot of people, and I think it has caused people to reset and rethink about risk in a different way.
I just wanted to reiterate that Realtor.com has, so many resources for our agents. We love watching your they're like 3-minute videos that you put up about the economy. It's at the national level, so but it is so informative. And then, all of the risk data that you mentioned as well. Do you, the buying process is obviously changing, right? As we're talking about it. Um, I'm just curious, is Realtor.com planning anything, utilizing AI, to, sort of enhance the information or access to the information for agents and consumers?
That's a really good question. I know that as a company, we are exploring how we can do this. I As I understand it, we want to be good stewards of the data that we get from the MLSs, and there are some limitations around how we can use that data with AI. So, but I do know that there are people working on this and thinking about it. And I also know that we did. It's no longer active, but a fun like experimental showcase, if you will, called the AI Dream Home. I think it was last year, where we, basically used an AI image generator to create dream homes, and you could type in anything, like your imagination was really the limit there. And then, after we ran that campaign, we took a look at the research and we found that even though people could have asked for like, a tree house surrounded by zoo animals and in the middle of, on the beach, they usually didn't actually. Their dreams were very, very realistic. They were often asking for the types of homes that you would see them buy anyway, like a 3 bedroom, 2 bath with, an open floor plan and that type of thing. So, that was a fun foray into AI, but it's certainly not the last thing that we will do. But I also can't speak to a lot of the details other than to say that we're working on it.
Okay.
It would almost be fun to take some of what we call the public remarks, the comments from the listing agent, right? And just copy and paste because, what's AI think if I'm describing it like this, what's AI? How does AI generate that, right? See where it goes. Okay, now you got me interested and I can't go see it. I can't
Uh-huh.
go play
Yeah,
with
that
it.
is that
Uh,
is interesting.
Tom, are we ready for the lightning round?
I think we are. Yeah.
Uh, I'll let
Does
you explain it to Danielle. It's a lot of fun. We get some great comments and answers about it.
Yeah. So we've got, I don't know, like 8 or 10 questions. And basically if you just want to answer yes or no, that's fine. Just, the first thing that sort of comes to your mind. Um, if you want to, explain it or put some context around it, that's fine too. But Mark, do you want me to go through it?
Yeah, why don't you do it?
All right. So here's question number one. Will we have a recession in 2026?
Ah, I've been on panels where they want yes or no, and I feel like economists really squirm with a yes or no to that that question. We always want to
So
contextualize.
maybe.
So, so I would say it's not my base case, but I think the economy is slowing, and so we're going to get closer than I would like. But I think we'll manage to avoid a recession in 2026.
Okay. Um, Question number two. The Fed will decrease Fed funds rate. This is a question. The Fed will decrease the Fed funds rate, resulting in a sub 6% mortgage lending rate in 2025.
Ooh, I don't think we'll see sub 6% in 2025.
Okay. Number three, will we see an increase of Bay Area buyers backing off of home purchases? That's
Oh, as in like
I,
walking away from contracts potentially,
or just I think a decrease in home buying.
a decrease in home buying. Um, no, I don't think so. I think the Bay Area market is poised to do pretty well because of uh that the AI developments in the tech sector, like we talked about.
Economic policy from the current administration will result in an increase in Bay Area job losses.
Hmm. I, you know, I think that my expectation is that in the Bay Area you'll be more insulated than across the nation. It does seem like we're getting close to the point where we may see some job losses nationwide. But I think even if we do see them, there'll be fewer of them in the Bay Area.
Okay. Uh, Less new hires for Bay Area companies will decrease migration to Northern California, resulting in decreased demand for housing in the area.
Hmm. Um, I think actually that probably was the case over the past couple of years where you had a lot of Bay Area and California in general migration from high cost markets to lower cost markets, like those in the Mountain West, like Denver, but also a lot to Texas. I think
Mhm.
our data suggests that that trend is slowing. So I don't think that we're going to see as much of that in the future.
Okay. We will see interest rate declines, increasing demand to such a degree that we will see upward pressure on prices.
I do expect that lower rates are going to help. I think um, we're not going to see upward pressure on prices like we saw a couple years ago, but I think it's going to be more like price stability because the market still has to kind of recover from the fact that all those affordability metrics remain pretty out of whack. And I think instead of seeing prices drop pretty sharply, we're just going to see them move largely sideways.
Okay. Will a weaker dollar mean greater foreign investment in the Bay Area?
Um, it could. It is sort of juxtaposed against the fact that we've seen some shifts in our international demand data from immigration policy, sort of turning some people off. So it really just depends. We've noticed the biggest decline in interest from Canada, but other countries have actually kind of seemingly stepped in to fill some of that void. So I'm trying to think about how those trends will localize to the Bay Area. My guess is that as long as the tech industry remains pretty solid, I think we'll continue to see foreign demand in California, and that the benefit of the drop in the dollar will outweigh any concern about immigration policy.
Okay. Last three questions. And we've already talked about this one. New home builders will slow down production in Northern California, therefore not increasing supply.
Supply is already pretty limited. I think in general, nationwide, they're slowing down. In Northern California, I mean, I think the fundamentals are still pretty solid. So I don't think the slowdown will be as pronounced as in other parts of the country.
Okay. Recently enacted policies and tariffs, if successful, will ultimately lead to a long-term boom for the area.
For the Bay Area in particular, I think we've seen some pretty substantial shifts in policy, and it is hard to say how all of these are going to net out. But I think so far we've seen a really resilient economy. I think just given how much I've seen and heard people talking about AI and the investments that they want to make relative to AI, I think that is going to outweigh any of the policy changes. So I do think that, I don't know that we're going to see a huge boom, but I do think that the Bay Area is going to be on solid footing.
Okay. Final question, and admittedly the most important one, Mexican food or Italian food?
I have pizza every Friday night for dinner. It's a family tradition, so I guess Italian.
All right.
I do want to ask one more question, Tom. It's off the menu kind of stuff because I just read about it this morning. Salesforce.com, a major tech organization based in San Francisco, but absolutely worldwide. They're announcing a pretty major layoff because they've been able to determine that AI can take over those positions, right? But I would imagine maybe you see this or can comment on it. I'm thinking, well, won't those people that got laid off just go into AI, right? They'll just drive down Highway 101 here in Northern California and join an AI group. So it just shifts it. Is that from a layman's approach, is that an observation?
Yeah, I mean, I do think if you, the skill set that you need to work with AI could be a little bit different, but
Right.
Something that someone pointed out to me, so I'm not the first one to have said this, but I did think it was intelligent when I heard it, is that you'll notice that a lot of companies that are like pitching AI or selling AI are still using humans to do to do the selling component for them. So,
Right.
there are aspects of jobs and interactions that AI will have have a difficult time replacing. So I think we'll see, I expect we'll see the makeup of the workforce shift. And so people will find different types of jobs. But, AI still requires, if you've worked with it at all, it still requires a lot of handholding and guidance. And you have to
Right.
be
Absolutely.
intelligent about the way you're prompting it to do things. So some types of work I expect it to replace and other types not so much. So I expect those people whose jobs are impacted by AI will find other things to do.
I read a recent article in the New York Times about what is AI replacing, right? Who, the jobs that you don't want in the AI world. But the jobs that they say it will have the least effect on, like you say, are the ones where a personal touch is involved, communication is involved, a relationship is involved, and that's real estate.
Hmm.
Uh,
Yes, absolutely. And I mean, I think, people have been worried about how technology will disrupt this industry and other industries for years. There's another stat, and I don't remember the exact number, so I'm going to butcher it a little bit, but the gist is, people worried about this when ATMs came out, and there are actually more bank tellers now than there were
Interesting.
um, before ATMs. So I think, those higher value interpersonal skills, like you talked about, it just become that much more important in this environment.
Well, Danielle, any parting words of wisdom? What's an agent to do in Q3 of 2025, in a turbulent if national economy, but also locals, things are constantly changing, a lot of factors changing the marketplace. And I'm just trying to make a sale, right? I'm just trying to, what do I pay attention to in your mind?
Yeah, we just put out this report that we called our Cruel Summer Housing Market
Oh,
Report, and it was inspired by summer reading. I don't know if you've ever read Anna Karenina. Um, I will admit I've not read the book, but I have seen the movie. Um, but the book begins, all happy families are alike. Each unhappy family is unhappy in its own way. And in talking with, agents and brokers and MLSs across the country, we've heard people say that, is the kind of market where nobody's really happy. That even if people are able to successfully buy a home or sell a home, they're probably paying a little bit more than they wanted to, or they walked away with a little bit less money than they had hoped to. So what that report does is it goes through and it looks at, the affordability situation. That's why buyers are unhappy. The market shifts. Sellers have more competition now. That's why sellers are unhappy. Even builders are unhappy. But it sort of also addresses the fact that things could be much worse. The market is adjusting to a more balanced state after years of being an overheated seller's market. And it's not pleasant, but it beats going through a catastrophic crisis to make that adjustment really quickly. And I think the best way for agents to kind of navigate this, because I think they are often stuck in the middle, sort of bearing the brunt of everyone's frustrations and unhappiness, is to try to help people, have realistic expectations getting into the market. And to lean on those interpersonal skills and that empathy that, agents are really so good at. And to remember, don't take it personally. People are frustrated by a situation that's frustrating. But to the extent that you can sort of reflect that back to them and be understanding, I think your clients are going to be a lot happier, knowing that they did well in a challenging housing market.
Realtor.com, the news and insights section. It's a tab across the top on the far right-hand side. As Tom mentioned, your great videos that we watch, absolutely. But I think everyone should be visiting that page and keeping up to date because Realtor.com's is a great resource for realtors in the marketplace.
Thank you. I appreciate that.
So, Tom, any last words, questions?
No, I think we're good. It's been just a real pleasure talking with you, Danielle.
Absolutely.
Thanks for having me.
Yeah, I look forward to having you back, and because your insights help these people get the job done on a daily basis, and that's the most important thing.
Absolutely.
Thank you very much,
your
everyone.
Pizza tomorrow night.
Yeah, pizza on Friday.
Thank you.
Have a good weekend, everybody.
Bye
now.
See you.
Make sure to check out our Pro Support page for additional videos on a full range of topics. And don't forget to click that subscribe button on our MLS Listings YouTube page.